Capital structure is one of the most debated topics in corporate finance, both theoretically and practically. In reality, no single formula defines the perfect mix of debt and equity. Executives often rely on rules of thumb and situational judgment rather than chasing mathematical precision. The goal isn't to hit the exact optimum WACC, it's to stay close enough to the zone where value creation is positive. In other words, being around the optimum is good enough because the choice depends on the firm's situation, industry, and the risk appetite. Now, let's see how theory helps us understand this balance in our next slides. The Miller-Modigliani benchmark forms the theoretical foundation for understanding capital structure. It shows that in a perfect market, financing mix doesn't affect firm value. In practice, however, taxes and distress costs create a trade-off, and the optimum capital structure lies where these opposing forces balance. Now, this balance drives value creation, which in turn enhances valuation. Now, let us bring this theory to life with a simple numerical example in our next slide. Imagine an SME with a 10% return on invested capital, a 12% cost of equity, and a 5% cost of debt. As the company borrows more, the weighted average cost of capital, or WACC, falls because debt is cheaper. But this only creates value when the return of capital exceeds the cost of capital. That's when leverage starts working for shareholders. Borrowing enhances ROE and the firm value, but only within the optimum zone. Let's visualize how this optimum zone looks like in our next slide. Here's the graph that shows the relationship between debt ratio, WACC, and the firm value. The blue curve represents the firm value. It peaks at around 50% debt. The orange curve shows WACC. It's lowest at the same point. The green curve represents value creation. It turns positive and plateaus beyond 60%. The intersection of this curve defines the optimum capital structure, where financing is efficient, sustainable, and the value is maximized. Now let's break down why 50% debt is the sweet spot. At 0% debt, the firm relies entirely on equity, that is expensive capital, high WACC, and negative value creation. At 20%, WACC falls slightly, but still above ROIC. No real benefit yet. And at 40%, WACC drops below ROIC. Value creation begins. At 50%, WACC is minimized. ROIC exceeds WACC by 1.5% and ROE rises. This is the optimum zone. Now beyond 60%, ROE looks higher, but risk and the instability grow faster than returns. So the 50 to 60% range is where the value creation is strong and risks remain manageable. Let's wrap up with a key takeaway in our next slide. For ease of understanding, rely on your company's own computations of ROIC, WACC, and the cost of equity. These internal ratios reflect your real financing conditions and make the analysis practical. Remember, don't chase the highest ROE, chase sustainable value creation. Stay near the optimum WACC zone because being close enough is strategic. Use leverage as a supportive tool, not the main driver of valuation. Real value creation comes from stronger cash flow and disciplined financing. When SME understand this balance, they build stronger and more resilient companies. Now, this video on finding the optimum capital structure is not part of my Democratizing Business Valuation guidebook, which focuses only on valuation methods. Instead, it shows how financing choices, the balance between debt and equity, can create value by increasing cash flow. And when cash flows grow, the business valuation naturally rises. Think of it as a complementary concept. Valuation tells us what a business is worth today, while capital structure decisions help shape how that valuation can grow tomorrow. Thank you for watching. If you found this helpful, please give me a like, subscribe, comment, and share this video so more entrepreneurs and SME can learn how financing decisions drive value creation. Thank you.